best we can do is give people a clear view of the future. Maybe not only of the housing market, but maybe specifically of multifamily. And that has really motivated the upcoming report that we have, and we're going to give a sneak preview here, if it's not already published in the interim, predicting the future of multifamily. And I hinted at this before. I think that we are in this uncertain, but I would say consequential moment in the economy and the multifamily market, and we wanted to help people find where and when to find those strong multifamily markets. Now, what's going to happen in the future? And
so this is the crystal ball.
Yeah, this is, and I worked.
This is the tea leaves.
Yeah, we worked with our data scientist. Maybe call him data scientist John Chapman. He built this model that factors in vacancy, job growth, and supply growth. And he also worked on supply growth itself, and then factor that in to predict rent growth. And we get an idea of these. We picked 10 select markets, but we also did some national numbers that you can see here that show that rent is set to recover as supply goes down. But it's a lot more nuanced than that, because the factors that are the weight or the power of vacancy, job growth, or supply is going to be different for each different market. And like I mentioned before, when we were talking about the State of the Nation's housing report, there's a big divergence in some of these markets, and it's not just a flat. You can't really look at the national numbers and find an accurate number for your own specific market. You're going to have to do your own homework on that.
The only thing that I think the national numbers are really beneficial towards is understanding sentiment, investor sentiment, and then also a trajectory on CPI and inflation.
Yeah.
With again housing being a third of a component of CPI, if you have an idea of where rent is going, but again you have to keep in mind that it's such a lagging indicator that we've had years of negative rent growth and it's still positive on the CPI.
And the broad trends in the national are present in the individual markets.
True.
But it's just like you're going to see some huge variation. So there's a spike in deliveries, and then there is a pullback. Well, you're going to see a spike and pullback in all of these markets, but some are just crazy, and some maybe don't even have that spike or don't have that pullback.
Well, some markets it's not dramatic because they didn't deliver as much as other markets, and so there's just not as much to pull back from. Like a lot of these Midwestern markets, there's a little bit of a surge, but they're coming back to kind of norms, and so it's not as dramatic versus some of these Sunbelt markets that were up here, and now it's... Yeah,
just to highlight, though, this uncertain moment, it is, we have the previous challenges. We've coming off of 2 years of, if not more, of low rent growth and high expenses for apartment operators. We've got these looming loan maturities that are a big problem to a certain specific group of apartment owners and operators. You've got this, economic uncertainty, high interest rates, and we're caught between this wave of newly built apartments and a sharp drop off in apartment construction, and rent growth is low. So we can hope for the future. We don't know what's going to happen, but we know in the past it hasn't been that great. So things are so cloudy, and I think just in the same way as there has been relatively little purchasing of apartments in the past few years, so it hasn't been great for price discovery. I think in the same way this year for renters, they haven't been as active in they've been doing new renewals, and maybe that has that's kind of hurt rent growth is what's kind of, it seems like it happened, because there's just been this similar stagnation in this year as it was last year, as it was the year before. So we looked at things, like I said, vacancy, job growth, and apartment supply, and we've charted out how these individual markets will perform, and a little bit you can imply or infer how regional performance has been based on some of these figures.
Yeah, Kansas City, at least in this selection of markets, Kansas City's taking the top spot of projected rent growth for 2026, at least in the second quarter of 2026. The Great Capital Report is saying Kansas City is going to be growing rents by about 3.5%, followed by Tampa, Florida, 3.2%, Miami, 3.6%, and Seattle, Washington, 2.68%. Indy 2.59, then Philly 1.5, Columbus 1.35, and then in the negative, Denver negative 0.5, Austin negative 1.25, and then Phoenix negative 2.4. That's rough. They've got a lot of supply still coming online.
Yeah.
I mean, that's the direct. It's not an immediate correlation because again, there's other factors, but certainly a big impact. The markets that have the least amount of the most supply are seeing the largest declines.
Yeah.
But Tampa and Miami, a good amount of supply is coming online,
Yeah.
and they're still growing.
Yeah.
2 and 3.
Well, and
spot
that's
2 and 3.
that is a lot of that is due to job growth. And if you want to keep scrolling here, and
Yeah.
we've got these got a little bit more details for some of this stuff here. Just starting with Austin, the story there, and because we don't have job growth listed in the graphs here, so what you're seeing is rent growth and supply growth. Now the line for Austin is still negative, but it is recovering really quickly from. So it's recovering basically from like negative 5% all the way up to negative 1.25. So yes, it's still negative. Rents are still falling in Austin, but the speed of that fall is a lot weaker. It is almost implying that maybe it's going to get to positive quicker than you might think because of the really strong job growth. I will say though, one of the suppositions that that John and I have been making while we are working on this is there a threshold of new supply that makes it so that there are different rules about it. So and I would say, and this is just a back of the napkin thing, is if it is growing by more than 1%, the supply each quarter, it seems to put it in a different category of these like ultra high supply.
4% a year or 1% a quarter puts it in a different category.
Seems to, yeah.
That's when the high supply starts really impacting.
In a different way.
Interesting.
And now I would have to look to John to see, but this is something that we kind of tested a little bit, and
it's
seems
good.
to bear
It's
out.
good to know. I mean, just for the future, you start seeing that the new supply relative to existing inventory go above 4%. You might start seeing some declining rent growth. That's a good back of the napkin.
But regardless, Austin is not going away. It's got such huge job growth that it could overcome even that. So I think that with close to the highest job growth in the country, continued demand will drive that recovery. And we'll just have to see for Austin. Columbus, Ohio, similar. It's got pretty decent job growth, but it had a little bit more of supply. And we can skip around here if you have another apartment that you want to look at.
What market did you find interesting?
Indianapolis. Matt? I think Indianapolis is just it looks so good.
So is this a good sweet spot or what?
Yes, I think it's a good sweet spot. It's actually in a good spot. It's got low supply growth. It has elevated job growth. It has job growth that can compete. Now, I have a tab open on my computer that shows the job growth of all 10 of these as lines, and I'm looking and I'm isolating. And it's over the 3 years that we look at in this coverage, it's competing. It's competing with your Phoenixes sometimes, and it's not Austin, but it's above a lot more than you would think. And so with that strong job growth, you got low supply growth, you have rent growth increasing. The difference between Indianapolis and Kansas City is that even though Indianapolis has larger job growth, it has a little bit more elevated vacancy that has depressed our rent growth projections relative to Kansas City. So that's just something about the existing market conditions in Indianapolis. That's what vacancy represents. But yeah, again, like that, this is the exemplar for me of Midwest stability. Is it doesn't have to be a perfect market in like going off fire, but if you've got decent, steady job growth, and if you have a supply that's manageable, then you're going to see good rent growth, and that's what our projection is. It's 2.59% rent growth projection, which is up considerably from where we are right now. The updated version of that is going to have the two rent growths side by side.
Oh, wow.
But this is just what we have here in the preview.
And I think it's worth noting that again, markets have different submarkets with different rates of growth. I mean, you're going to go into the suburbs and you're going to see much higher rates of growth rather than in Marion County, Indianapolis proper.
And then if we want to scroll down to either Miami or Tampa, because I mentioned those earlier. So Miami is it is so indefatigable. It's like an immortally. There's nothing can budget.
It's like the hammerhead worm.
Yeah, exactly.
You keep chopping it up.
It just grows five more hammerhead worms. But yeah,
which is frightening, by the way.
Yeah, I know. I think that I've seen this. I think that if you grind it with your shoe,
you have to, right? Anyway.
Yeah. So Miami has it's supply. Now, I was talking to John Chapman about this as well. I was like, what is the X factor here? And for Miami and Tampa, you can kind of group it together because it has had relatively high supply, higher than the Midwest, but it has had rent growth arguably higher than the Midwest. Right now, it's 3.16. It's higher than our projections for Indianapolis because the supply is so exceeded by, there's just not a lot of places to build, or they're not building as much in Miami. Also, retirees are boosting demand more in Miami and Tampa, and those aren't reflective in the job growth. So that is that's led to our
Well, they've got the new alligator Alcatraz that's going online outside of Miami, so maybe that's a little surge in population as well.
Oh man, data centers and detention centers, I guess. These temporary boosts in employment.
Miami's got its own thing going for it. It always has.
I remember saying this even like every year. It seems like we're tracking all these. Everything moves crazy, but Miami just does its own thing and it does it well. It's
party in the city where the heat is on, Matt.
I
all
guess.
night on the beach till the break of dawn. So I mean, I don't think Denver has that song about it. I mean,
but Denver is a good example though of
Rocky Mountain High.
I thought that's Colorado.
Yeah, Denver.
Yeah.
Mile High City.
Yeah. Okay.
But
good.
I mean, it's a different vibe though.
When it comes
slower
for our projection, it is slower moving, and this is one where you had job growth that wasn't high that can't be that countervailing force to the supply growth that it's had. So we've got negative 0.5 for our rent growth projection, even though the supply isn't like huge. It's not like it's getting 10% supply growth or anything like that, but still the job growth just was not enough to supply kind of bolster the demand.
Denver was a great market, but then it got high.
Yeah, that's true. Legally and structurally when it comes to their housing. When it comes to their multifamily housing.
Denver's a good town.
Yeah. And so that basically summers. I don't want to give away too much about this report, but we do have some information.
Where do I get this report? This is great.
So you go to www.graycapitalllc.com/future. So if you want to know how to predict the future of multifamily, you go to Future. And I want to move from that future to a little sharper look at the present for the and actually if we want to move to the apartment list report, it has a really good